Trickiest part is that triggers can always reverse. Yeah, that's why we need to make sure we have a winner, right? So what does that mean? We need continuity in our favor. So think of it this way. When we're looking at a chart, right? If we're going to have a monthly signal, let's say we have this monthly signal, it breaks and it stays good. So it's above that break and it ends the month like this. What's happening is price is aggregating on the offer, which means what? They're buying, right? They're taking the offer. So what does that tell us? Every upside signal during this month has a higher likelihood of working during this trading month because the month is green, it's going up. And because we have this signal in force above this, it's going up this month. So that's the first way we add evidence, which tells us what? Throughout this month, what we're going to look for is we're going to look for it to go up, stop people out, and then keep going. Right? And then we're going to look for it to create new signals, stop people out, and then keep going. So using the lower low to time this signal back into this green month to make it greener. And then when it reverses, get out or reduce. Then we're going to use the lower lows to time this signal in the direction of this month, and it's going to get greener. So you can think of it like they're buying the stock, and then there's new shorts entering the market or profit taking, and then they come back to buy more of the stock. Then there's shorts or profit taking. They bought a little bit, right? Didn't go anywhere. Then they stop some guys out, new lows. And then they go and buy more of the stock, and you had shorts, you had profit taking. So you have buying, profit taking, slight buying, profit taking, then buying. And you can also think of this profit taking as shorts. So you have buying, and then people get short, but they're wrong. The month is still green. Then buying, get all the shorts out. Then you have people getting short, but they're wrong. It does go up, so they can stay short. Didn't stop these guys out. Then reversal. And when this reverses here, this signal causes all these shorts to cover, and the month is green. So when we have this lining up of time frames, we increase our evidence. And then you'll catch the one that does this, right? Signal, and then boom. So let's go and look at SPY. This is the last thing we'll cover. I'm going to be hopping off at 11. But if you look at SPY, we can use the US 500. Let's just go to like a 4 hour and a month. So if we go to the month on the US 500, you'll see monthly down, reversal. So during this trading month and the next month, we're targeting to new highs, lower lows, back the other way. So if we go to like a 4 hour, all we have to look for is new lows and then try and time the signal back into that. So you'll see this is where that month broke. There's going to be more signals down here, which we're not going to talk about today. But you'll see we make lower lows and then the inside signal, and then boom, you're in. You just let it go. Lower lows, and there's going to be a little bit of a mess in here, but then they go, right? And there's some slight lower lows that make new highs, and then you'll see they go sideways. So what we're waiting for is lower lows, signal, gives you a little bit, lower lows, signal, and then off they go. They're gone all the way up. So what's going to happen is you'll have small wins, small losses, and then you get this big winner, boom, and you're just in, right? And you're still in. We don't have to get out of that. So we can time that. If you go to a day, it's going to be even more clear. So you'll see the month broke in here. The big lower low on the day occurred in here. Lower low here, boom, right? And that was the only one. If you get like a 12 hour, you'll have, slightly more. So depending on your time frame, you'll have more signals or less, right? You'll see on a 12 hour basis, we have this lower low in here, this lower low in here, this lower low and this lower low, and that was it. Then we had, more recently in here, and then today it's slight lower lows, but we want to see the big lower lows because that's what's going to cause much bigger moves. So this is the last week's range. We're inside week. This is why we don't like trading inside bars. We want to see them tick down and then boom, right? So we can get a big move, or at least tick up so we can get a expansion. So that's how you're going to add evidence. The next way we add evidence is not just the monthly time frame, but looking at the whole market. So this is why the scanner is so useful. So if we just go to historically, let's just say June, May was when the market reversed and bottomed. So see May, it bottomed out here. So the first thing I want to do is show you. So this was the video that we put out over 2 months ago, and you can see this is 4/30/2025. So this video was put out during the month of April, right at the end. The title, I did not change it. This has been the title since we uploaded it. We're expecting the market to fully recover. The reason is because of this. You'll see across the market, all of the market, real estates have a hammer, right? That's a bullish signal. Materials have a hammer. Communications hammer. Utilities have a hammer. Staples, communications, semiconductors have a hammer. Home builders, financials, discretionary. So you can see all of these are about to be a monthly reversal. So we call this simultaneous break. So when the whole market goes 2-2 month, it's going to fully recover every time. That's what happens. So if we go to any previous, simultaneous break, this was when the SPY, the whole market went 2-2 month in here. This is, November. So towards the end of 2023. If we go to COVID times, the whole market went inside month up in here, May of 2020. And that caused the big COVID rally or post-COVID rally. And the same thing's true, in the 08 crisis, everything reversed off of these lows in the SPY in this case. So when we line up the whole market doing something at the same time, we know for a fact they're buying. So if we know where they're buying, then all of the things I just showed you with the lower lows, what you're looking at is they're buying, and then the bears, they're selling it, and there's profit taking going on. So we're stopping out people that were long in this stuff, and people are getting short. But we know they're buying the whole market. So guess what happens when that buyer comes back? You make your slightly lower low in here, and then boom, right? They send it. The slight lower lows in here, and then they send it. The slight lower lows in here, and then they send it. And then the bigger lower lows in here, and then they send it. So what's happening is going up, people get short incorrectly, people start profit taking, and then they buy it. Boom, all the shorts get out. And that's just going to keep repeating. So we want to think, right? If this is the really big range, new highs, new lows, and then we have simultaneous break up, the whole way up, lower lows, then send it. This is what it's going to do. So if we go back to Hood. Hood was a simultaneous break on the month with all these guys, 2-2 month. So until that monthly reverses, all we're looking for is lower lows to go after it again. So if you go to let's say a 2 hour, just something to reduce a little bit of the noise. The whole way up, we'll actually go to the 60, why not? We'll just show you a few. But the whole way up, you'll see they go, and then everyone's long. So we got to get people short, we got to stop some guys out. They stop some guys out here, and they reclaim it, and then they go again, gap up. Take some profit on the gap up, stop some guys out, reclaim the morning lows, and then they go again. Lower low here, they reclaim with the 60 reversal, they go again. You'll see gap down, slightly lower lows in here, and then they go again. Slightly lower lows in here, and then they go again. And then you get the bigger lower lows. They go again, make the new highs. You'll see you get stuck in the middle here, so you get more of a broadening formation. But you'll see the lower lows in here, they reclaim it, and they go again. So that's all we're looking for, right? And this doesn't mean every single one's a winner. However, when you get the simultaneous break, you got about 90% to 95, 98% chance it will win. This is how we want to or how to get in things that are already going. When it comes to the simultaneous break, then when you have it happen, that's the entry that's pretty much a winner every time. I'd give you like 95% odds. So when you see it on a daily, monthly, weekly basis, 60 basis, you can hit it and know that 90% of the time that's probably going to work. So if we go to, the indexes today, the reason it's a mess is because we don't have that condition. Right? We go to the week, we do not have that condition. 70% of the market's going inside. It's not like 70% of the market's going up or down. Versus, if we go to like the month or quarter, the month, right? 60% of the market going up this month. This is what we want to see on a daily, a weekly, 60-minute basis to really get stuff moving.